Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, coming to you live from the Piper Sandler Global Exchange Conference. This is the annual gathering of the trading community, the heads of all the global exchanges, including the NYSE, the NASDAQ, CBOE, CME, even the London Stock Exchange is here, along with the crypto movers and shakers, trading platforms, all here to talk about the state of trading. Let's do that with Howard Lutnick. He's the chairman and CEO of BGC Partners and a friend of mine for many, many years. Good to see you, as always. I want to ask you about the debt ceiling because it's been an important inflection point in the market since last week. The downside here that everybody keeps writing to me about is the U.S. Treasury is expected to sell an enormous amount of debt to deal with this.
$1 trillion.
$1
trillion. That's an enormous amount.
In fact, that's a lot of zeros.
That's a lot of zeros.
What does this mean then for bond investors? What does it mean for the economy?
Okay, they've been draining supply, right? So rates have been lower than you would think in the Treasury bill market. Now they're going to hit it with all huge $1 trillion of sales that will make short-term Treasury rates rise, and that will feel like an interest rate hike from the Fed. So you've got the Fed with all this selling, it'll feel more constrained, right? So that will help them skip, pause, don't raise, another way of saying it. And then you've got these regional banks going out of business. They took $1 trillion out of the regional banking system, put it in money market funds and in the big four banks, the systemic banks. That felt like a hike also. Right. So you have both of these things are going to constrain the Fed. The Fed is not raising. Don't buy it. They're not raising.
Okay, so this is good news if you are worried about the Fed constantly raising rate. All of this is the effect of good news, but it is going to slow the economy down a little bit. It seems like that, doesn't it? I mean, there's a lot of money getting pulled away here.
Right, it's got the same effect, right? So they're not going to actually raise the rate. They're going to effectively tighten because the money came out of the banking system, and they've got all this selling going into Treasury. So you've got rates are effectively rising. That's the same as the Fed rising. And that's good for BGC Partners. So what BGC does is we trade on volume, volume, volume. This is all really good for volume. We got it up 9% for the quarter. So we're feeling really good. Volume's back, rates are back, business is great.
But isn't raising the debt ceiling over the next year sort of a drain on global liquidity? Is this a headwind for the stock market?
I think it's a headwind for the stock market. I do. Higher rates, remember, low rates push people to take risk on, go buy stocks. You now have people saying, hey, maybe I should just put my money in treasuries. I get 5%, take no risk. And that's money coming out of the stock market. So I think the stock market's kind of on a sort of a steady kind of pause. We felt it the last couple of days, not up, not down. It's all AI, but the rest, not as good.
Yeah. The Fed is also continuing its quantitative tightening, right, at this point? There's more pressure on bonds as a result of that on top of it. So we've got several factors here that are conspiring essentially to push rates up.
I think the Fed's got to stop their quantitative tightening soon. It's enough already. It's enough. You have the Fed coming in and selling. It's all going to go just kind of quieter, more steady. The Fed's going to stop pretty darn soon.
We've spoken often about the competition that treasuries and the money market funds and ETFs are presenting for the stock market right now. Money market yields are continuing to rise. They're about even with the earnings yield of the S&P 500, 4.5%, somewhere around there. Are we going to continue to see money flowing out of equities and into money market funds and treasury bond ETFs?
I think it's going to continue because people are just starting to get into their heads. I can make 5% without risk. Imagine that. I can make 5% without risk. So maybe some of those stocks don't look so good. So you're going to see the stock market go sideways, but the bond market's going to continue to draw in money and get a lot of power. So bond markets are where people are going to be talking.
Yeah. You know, I want to talk to equities. The S&P is trading at the current levels at 2023 estimates at nearly 20 times 2023 earnings. That's not what I would call a recessionary multiple. And folks, if you don't know, typical is 17 times. But when you're talking about recessionary multiples are 10, 12, 13, we're at 20. The stock market is not signaling any kind of recession at all. What does this tell us? Does it mean anything, or is the market misreading things?
Well, it's a fun place to bet now. You've got the 2-year note that says, hey, it's only at 4.5. right? And overnight rates are at 5. That means they must be expecting a cut. The only reason they'd cut is if there's a recession.
Yeah.
You've got the stock market at highs. What's wrong with this picture? It's one of the two. Is there going to be a recession or the stock market? I would bet on a recession. The bond markets tend to be more right. So I think stocks are going sideways to slightly lower. That's just the way it's going to go.
It's remarkable because the earnings are not dropping. Essentially, everyone's been wrong expecting this earnings, not only a recession, but an earnings recession. In a recession, normally you get 10, 20, 25% drop in the earnings, and the estimates haven't changed for this year. It's basically flat compared to 2022. So everybody says, well, the analysts are idiots and they're slow to react and they don't move fast enough and they're waiting for the CEOs to tell them what to do. But so far, they've been right. The market has been correct so far.
But what you're seeing is a tighter credit market. When companies come to the market to borrow, there's tighter. There's just not as much money around. Rates are higher. It's going to be tougher on them. And I think you're going to see it start to weigh in. You got the real estate market. That's going to have a tough time. Every time commercial real estate loan comes due, they're having a tough time re-rolling those loans. Tough markets in real estate coming. Tough markets rolling your debt in the credit markets. Tighter credit means eventually it feels like a weight on the equity markets. It's going to pull us a little lower. Not a lot lower, but a little lower.
I can see what you're saying about commercial real estate. I have a friend in the business, and he said, well, normally these commercial loans are 5 years. Right now, they were 4%. The ones that are rolling over now, I'm seeing 9%. So if you've got a 5-year commercial loan rolling over, I said, what does that mean? He said, well, you know what it means. Some people are going to hand back the keys. That's what it means. They're not going to be able to afford that. So it totally makes sense to me what you're saying on the commercial side.
$1.5 trillion of commercial loans coming due in the next 3 years. 500 billion of them are going to throw the keys back to the banks. So the banks are going to be in a tough spot.
Wait, say this number again.
1.5 trillion coming due in the next 3 years.
You think 1/3 are going to turn the keys?
1/3, because let's face it, if rates go to 8 or 9, and your rents haven't gone up like that, the math doesn't work. Give the keys back to the bank. It's the greatest change in commercial real estate over the next 3 years. Together, we talked about it here right now together. It's coming like a tidal wave, and it's going to change a lot of things, and it's going to keep the Fed's hands nice and tight. They're not raising rates.
You heard him, not raising rates. Now, regional banks, I want to talk to you about that. They've been rebounding recently. These concerns seem to have ebbed a little bit here. About deposit flight. Is this no longer an issue, or is this going to somehow come back in some new form and bite us, essentially?
It's going to come back, because if you think about it, if the deposits don't leave, but you now have to spend 4% on your deposit, you were paying 20 basis points, and they're going to pay 4%? Seriously, how do you make money? You've got all these old mortgages you put out at 5%. And you were only paying 20 basis points on your loan, on your deposits. Now you're going to pay 4%. I just don't think their business model is right. I think the regional banks are in big trouble. We had 4,100 of them in America. If you said, what?
Yeah.
Why do we have 4,100? What if we had 3,600? Do you think anybody would care? Yeah. The people who own them would care. The rest of us?
Yeah.
I think there's going to be way less. And the Fed's going to have to allow the big banks to buy them.
Paying that 4%,
that's a change.
that 4% is an enormous number. I made fun of my mother 2 months ago, who called me pulling money out of her bank account, getting 0.2%, saying, Robert, I'm putting it in a 1-year CD, and should I buy bonds directly from the government? I said, Mom, don't go buying bonds from the government. The CDs are perfectly fine. But there's the problem.
There it is. If you have to pay 4% on everything you used to pay 25 basis points for, that's a really big change in your business.
Well, just a couple minutes left. Let me get to your thoughts on the economy here. The economy refuses to die. You know, everyone is waiting for a recession that hasn't come yet. Is it coming? We've been waiting for this for 8 months, 9 months, 10 months.
It's got to be coming, but it is very impressive. The statistics you keep seeing continue to show us growing. If you looked at the statistics, so the service sector is still on fire of inflation. Food, you go to a restaurant. Can you believe what things cost? Go to the supermarket and buy some eggs. It's outrageous how they've doubled in price. So these things have got to hit in the economy. I think a recession is going to come at the end of this year. It's coming.
But it's a mild one.
It's a mild one.
Okay.
Right. I agree with you.
All right. So is it soft landing? That's a soft landing.
Well, it's a mild recession. I don't know if that's a soft landing.
Comparatively.
Better than a bad landing, I guess.
Is a soft landing slow the economic activity down? It's going to bring inflation down. It's going to get the Fed to stop hiking rates. You said
Fed's done. Fed's got to be done. All these factors are going to stop the Fed. All this stuff, talking about skipping. How about they were talking a couple of weeks ago about raising rates? Now that's gone. Now it's a skip. Now they think July is a 75% of a hike. I don't think there's a 75 chance of a hike. I think it's not coming. I think the Fed's got to calm it down because they're worried.
The theme of this conference is the future of electronic trading. You've been around a long time. You've seen the whole arc of this thing. Talk about artificial intelligence. How about AI? How is it going to change the economy? How is it going to impact your business? How is it going to impact CNBC viewers who are traders, for example?
Everything is going to get more efficient. All right, it's just going to get more efficient. Programmers can say, I need A, I need C, go fill in B. That's going to happen across the board. When you're looking for investments, you're going to say, what's the cheapest stock? What's the cheapest this? What's the cheapest that? It's going to let you be much, much more efficient. It's going to be tough on the people, what I call the belly of the beast, right? The best people will be employed. The young people will still be our future. It's the belly of the beast that's going to be in trouble. And, AI is going to automate a lot of those jobs. And it's going to make things more efficient, but it's going to be tough. And that's why these companies are doing so.
The important thing, I think, here is that we're going to see some big changes coming in the next few months. The problem is the viewer is rather confused about the state of the economy right now. But you think the soft landing is intact, or relatively soft landing. So I know
it's not a smash.
But what you're saying to me is very optimistic, actually. I think the whole point here is you don't see imminent crash in the stock market, right?
I do not.
I know you don't have year-end targets. You're not a strategist, but where do you think we're going to be at the end of the year?
I think the equity market's slightly lower than here at the end of the year, but not a big deal. I think rates here at the end of the year, not a big deal. I think, unfortunately, what I've got to say is not a big deal. Not a big deal.
Okay, that's reassuring to everybody. This is a man I've been talking to for more than 20 years, folks, so I very much value his opinion. Howard, thank you very much for joining us. We really appreciate your time.